Hello, firstly, let me talk to you about our objective of this study. Our study aims to model both the short-run and long-run relationship between the gold price and the other important economic indicators. What makes this study unique is our attempt to detect and incorporate structural risks, both the exogenous and the endogenous, into the estimation process. Acknowledging the disruption caused by the major events such as COVID. To analyze this relationship, we use the ARDL model, which is stable for mixed orders variables and allow us to enter both short-run and long-run relationship. We focus on several determinants. Firstly, the inflation, which is measured by the consumption price index, and the interest rates, price, exchange rates, and the stock market indices. This study is set against the backdrop of the COVID, which created an unprecedented economic environment. This crisis disrupted global trade, consumption, and investment, forcing a rethinking of traditional financial relationships and also reform gold's role as a safe haven asset. So we hope our findings will offer useful insights for investors, policymakers, and researchers regarding the dynamics of gold price across different economic environments. And let's move on to the theoretical background. Our study is grounded in basic price theory, which holds that price determined by supply and demand. However, gold is unique in that it plays a dual role. It functions both as a physical commodity and financial assets. Past studies have highlighted multiple microeconomic factors that influence gold price. According to the Sharpie and the Topo, the gold price are not only influenced by the traditional factors like mine production and central bank sales, but also shows strong correlation with oil price and inflation. The transition of a floating exchange rates system after the collapse of the after the break of the Bretton Woods system increased gold price volatility. In fact, the studies show that a weaker US dollar typically leads to higher gold price. Another important relationship is between gold and the stock market. The Smith found a weak and negative short-term correlations between gold price and the US stock index, with no long-term integrations, which further confirm gold's function as a safe haven during time of the market stress. Let's now look at some more detailed relationships. Firstly, the inflation. During the period of rising inflation, the real value of cash holds declines, so which lowers the opportunities costs of holding those as a result. Often, approach this as investors seek to preserve value. In terms of the supply, the gold price is quite different from other commodities, so any reproduction is very small. That's why our study excludes the supply and demand factors from the model. We also look at the oil price. Found in 2006 and 2017, found a long-term fractional co-integration between the gold and the oil price, indicating a deep structural link between these markets. As for interest rates, the relationship is twofold. In the short run, lower interest rates reduce the opportunities cost of holding gold, leading to a higher demand. In the long term, the rate cuts can influence expectations about the US dollar depreciation, indirectly pushing the gold price up. So finally, gold price has significant spillover effect on the stock market. One study found that the gold influences the S&P 500 index over the long term. These effects were intensified during the COVID, particularly from the March to May in the 2020 year, due to the rising uncertainty and marketing volatilities. So in conclusion, our study not only investigating how the microeconomic factors affect the gold price, but also attempt to model these effects on the structural changes like the COVID.
Hello everyone. Data source and sample period. The sample data is on a monthly frequency and starts from January 1981 and ends in April 2025. So this means that we have about 568 observations. Our dependent variable, which is gold spot price in USD, comes from the World Gold Council. The S&P 500 stock market index data comes from Yahoo Finance, and the remainder of our explanatory variable data comes from the Federal Reserve Bank of St. Louis. Some brief data definition. Gold spot price is the current price at which gold might be bought immediately. West Texas Intermediate is a grade of crude oil, which is one of the three main benchmarks in oil pricing. Consumer Price Index is a weighted average of prices of basket of goods and services. Inflation is the gradual loss of purchasing power that is reflected in a broad rise of prices of goods and services over time. The US dollar index is a measure of the value of US dollar relative to a basket of foreign currencies. Federal fund rate is the interest rate that a bank charges other institutions for lending excess cash to them. S&P 500 is a stock market index tracking the stock performance of the 500 leading companies in the United States. So this is our base econometric model. So we're trying to model gold price given CPI, federal fund rate, S&P 500, US index, and US exchange rate, and also West Texas Intermediate. Since we're working with time series data, it's important that we visualize the data to ensure that the data is stationary. And what we can see is that the data is definitely not stationary. So this means that using simple OLS estimates will result in spurious regression. We've then performed correlation analysis, and what we found is that CPI is highly positively correlated with S&P 500. One of the innovations of our report is that we try to see whether the period after COVID-19 has a structural break in the gold price. We want to see whether gold price gets affected when there is such a pandemic. So we performed two different tests, which is exogenous structural break test using Chow test, and we found that given the dummy variable after 2019, November 2019, we can see that the p-value of the test statistics is significant, which indicates that there were structural breaks. And using endogenous tests, we wanted to see whether the period after COVID-19 is selected. And what we found is that using the biparent test, it is not selected. But the highest ranking structural break occurs in December 2009. So these two dummy variables will be utilized when we are estimating our models. So before we do that, since we want to estimate an ARDL model, we need to make sure that our data is stationary at I0 or I1. And given the ADF and KPSS tests using different estimates, we found that most of the data, most of the series are actually stationary at I1. So federal fund rate is stationary for some of the ADF estimates at I0. So this means that we can actually perform the ARDL estimation. And what we found is that estimating using dummy variable after 2009 is the one that has the lowest AIC value and is the most parsimonious. And also, it is significant, as you can see over here. And on the right here, you can see that this is actually the estimated value. So in the short run, we can see that an increase in the CPI by 1% will result in the increase in the gold price by 7.2 US dollars. For the dummy variable, the gold price is about $16 lower. Next, we want to perform the bounce test to check whether there are co-integration between the series. And given the bounce test results, we can test statistics for I naught. Sorry, it's actually bigger than the I naught and I1 value, which implies that it is statistically significant. And we then perform the error correction model, and what we've noticed is that the co-integration term is actually positive less than 1 and is significant. So this implies that there is actually no long run form for this estimation. We then performed the causality analysis using Waltz test, and what we found is that at a significant levels of 5%, CPI, federal fund rate, and US dollar index gradually causes gold price in the short run. However, since the error correction terms are not negative despite being significant, there are no long run causality, and this implies that there are no strong causality. Lastly, we perform residual diagnostic of the estimation. So using the Borch-Godfrey serial correlation test, we cannot reject the null hypothesis. Using the heteroscedastic test, we can reject the null hypothesis, and using the normality test, we can actually reject the null hypothesis. So this implies that the residual indicates no serial correlation, but are heteroscedastic and not normally distributed. What we've attempted to do is to utilize the White and Newey-West coefficient covariance matrix to remedy the heteroscedastic issues, but there were no improvements in the residuals.
Now move on to conclusion. The study shows that the most fitted model is the ARDL model using breakpoint 2009 as dummy variable with the largest R-square and the lowest AIC. The first model is performing OLS estimation, and in order to identify the structural break, the study employs the child test for exogenous variables and the biparent test for endogenous variables. For the endogenous variables, the result shows 3 breakpoints in December 2009, October 2018, and July 1998. The study focuses on the breakpoint in December 2009, which is possibly due to the zero interest rate and the quantitative easing policy of the Federal Reserve. For the exogenous variables, the start of COVID-19 is said to be the breakpoint, and the result is significant. The interaction term is also included in models to compare, and the results show that among the above models, the OLS model using dummy 2009 and the interaction term is the best. Then the study utilizes the ARDL model to explore the dynamics of the gold price after considering all the variables are I0 or I1. According to the error correction version, the error correction term is significantly positive for both models using COVID-19 and December 2009 as dummy variables, respectively. Simultaneously, the bounce tests represent a co-integration relationship between the gold price and the independent variables for both models. The study finds the breakpoints in December 2009, which is during the zero interest rate period in US, justifying the association between gold and the monetary policy. Additionally, both consumer price index and the US dollar index exhibit a short-run adjustment effect on gold price, providing valuable insights for high-frequency trading strategy. However, the model with breakpoints depends on the historical events, possibly limiting the generalizability to other policy cycles. The level equation also shows insignificance. This may be due to high correlation between independent variables or the omission of key long-term driving factors. Another takeaway from the study is the stability of the gold price as an asset, as it did not go through any significant structural changes in the short run. It is hoped that in the future, further research which addresses the issues of mathematical linearity by removing highly related variables or incorporating some key long-term determinants to enhance the model. That's all. Thank you.